My name is Stephanie Meyer. And today I'm going to talk to you about some different industries and 5 different companies in 3 different industries. Throughout the presentation, there are different types or categories of ratios. My first one is liquidity ratios. It's a measure of how quickly a company's assets can turn into cash. Next would be a leverage ratio. It's a measure of how well a company can deal with its long-term obligations. Asset efficiency, a measure of how well a company is deploying its assets. And profitability, a measure of how likely it is for a company to profit. And valuation, which is a measure of how expensive or inexpensive a company's stock price is. It's how the market values the stock. The 3 types of industries I chose: soft drink manufacturing, colleges, universities, and professional schools, and casinos. First, I'm going to talk about the soft drink manufacturing company. I did Coca-Cola, Dr. Pepper Snapple Group, Monster Beverage Corporation, National Beverage Corporation, and PepsiCo. Next to it, you'll see the symbols if you would like to look it up. First, I'm going to talk about liquidity. I did this on a Windows computer, so obviously some of the things didn't transfer right, but it's Coke's first, then Dr. Pepper, then Monster, National Beverage Corporation, and PepsiCo. Monster Beverage Corporation is the only company that can pay their short-term debt with cash, but only one of 2 companies with 0% short-term debt. So what you see here is you have your current ratio in the pink, you have your quick ratio in the purple, and your cash ratio in the orange. If your cash ratio is above 1, which is this one right here, Monster is the only one that has a cash ratio above 1. That means with the cash that Monster has right now, if they needed to, they could pay off all their short-term obligations and still have money left over. So in order to have all 3 of these ratios above 1, that's really good. But they also don't have any short-term debt. National Beverage Corporation is in 2nd place to Monster, which is right here, with having its current and quick ratio above 1. So this Monster has all 3 above 1. National Beverage Corporation only has current and quick ratio above 1. This means that they could pay off their short-term debt with the sale of inventory. However, they're also like Monster because they also have no short-term debt. So you have your current ratio, which is current assets over current liabilities. And you have your quick ratio, which is current assets with minus inventory. So it's your what assets you have without your inventory sales, because sometimes your inventories take a couple of months in order to sell and convert into cash. So without the sale of inventories, National Beverage would be able to pay off their short-term obligations. PepsiCo has the highest current and quick ratio, which is right here. And Dr. Pepper has a higher cash ratio. So right here you can see Monster is definitely doing the best. But again, Monster and National Beverage Corporation don't have any 0% short-term debt. So out of Coke, Dr. Pepper, and Pepsi, which they all have short-term debt, PepsiCo has the highest current and quick ratio. Okay. Next, we're going to talk about leverage ratio. We're still in the soft drink manufacturing. So I still have Coke, Dr. Pepper, Monster, National, and PepsiCo. And this is going to be your debt to equity ratio. Monster and National have the lowest, meaning that they have the least amount of debt compared to $1 of equity. However, Monster has 0% debt, and National only has 3.5% of long-term debt. Therefore, it makes sense that their numbers are lower. Coke is next in line. For every dollar they have in equity, they have $2.67 in debt. PepsiCo is next with a 327, and then Dr. Pepper with a 376. So each company's financial leverage has been steadily increasing, with only 1 year decrease in the past 5 years. So each company is about the same as far as their leverage ratio. The trends, at least, not the actual ratio. Next will be your asset efficiency ratio. Okay, National Beverage is leading this ratio with 3.1. This means for every dollar the company spends on assets, they're generating $3.10 in sales. Monster is second with 182, followed by PepsiCo, Dr. Pepper, and Coke, which at 87 cents, 70 cents, and 53 cents. Moving on to profitability ratios. Operating margin and profit margin are going to be my two ratios I use for this category. Operation margin tells us how much is left after variable costs of production, such as labor and raw materials. This ratio is influenced by management. Monster is winning with a ratio of 25.5%, followed by Coke with 21.83%, Dr. Pepper 18.38%, PepsiCo 14.61%, and National 10.73%. Profit margin tells us the percentage of sales that go towards net income. Coke is winning this one with 18.32%, followed by Monster 15.08%, Dr. Pepper 10.41%, and PepsiCo 10.15%, and last but not least, well, it is least, National with 7.09%. So this is showing us how well the companies can profit. So Monster, after paying labor and raw materials, Monster has 25.5% of their income left over to go towards net income. And then the profit margin is after everything is paid as far as labor, materials, fixed costs. After everything's paid, what percentage of the sales go towards the net income? And that is Coke. So Coke's doing better in that area. Okay. Next we have valuation ratio. Valuation, like I said earlier, was what the market values this stocks at. What the market thinks that the company should be doing in the future. So this is going to be your PE ratio, which is price to earnings ratio. Monster is dominating, as you can see, with a 33.89. This means that the market will pay $33.89 per dollar that they earn in the stocks. In other words, the market thinks very highly of them. Coke is in second place with a 19.86. Then PepsiCo is next with the 18.93, followed by Dr. Pepper, 15.52, and National, 14.41. So you can kind of see what the market thinks of each of these companies. Okay, conclusion. After evaluating every ratio, I come to the conclusion that Monster wins. This is over the past 5 years, and then I have the current up to 7/8/2014. All the other numbers we looked at before were the numbers for the ending of 2013. That way I can compare a whole year to each company instead of just part of a year. So this is for the past 5 years. As you can see, the quick ratio, which is right here, is kind of going, it goes up and it goes down. Right now it's kind of flatlining. But compared to the other companies, they're doing great. Then you have your leverage ratio, which is this purple line, and it's pretty much staying the same. I mean, they're not really taking up more debt, they're not really paying off any debt, they're just kind of staying the same. Asset turnover, so how efficient they're using their assets, and that's kind of staying flat line down here. The profit margin, how well they make a profit. 2007 it started a little over 15, then it comes down, goes back up, kind of comes down a little bit, flat lines down. Right now we're on an up curve. And then your PE ratio, which is how the market values. And it drops right here in 2009, but it steadily goes up to in 2011, comes down a little bit in 2012, it goes back up in 2013, and right now, it's kind of down. But before looking at the data, I would have guessed that PepsiCo or Coke would have been the company to invest in, because they're the ones that are most popular and bigger. However, after looking at the numbers, I would say that Monster Beverage Corporation definitely trumped the other companies. Monster is the most liquid company with the least amount of obligations, with the highest valuation from the market. And they're also second most an asset efficient company and the second most profitable company. Monster also has the highest return on invested capital at 29.93%. And one recommendation for Monster would be to gain some leverage in order to lower their weighted average cost of capital of 9.6%. It's cheaper to have more leverage, and if Monster could gain more leverage and allocate some of their funds in different ways, they could actually have a lower cost of capital and become more profitable. So that was the soft drink manufacturer. Next, we're going to go to colleges, universities, and professional schools. For this industry, I chose Career Education Corporation, the Rye Education Group, ITT Educational Service Incorporated, K-12 Incorporated, and Universal Technical Institute Incorporated. Of course, first, we're going to do liquidity ratios. So for this, if you look at it, your current ratio for K-12 is about double the next highest. So they're really dominating. And as well as the quick ratio is about double. The cash ratio is kind of tied. So a little bit more detail. K-12 and Career Education Corp are two companies. It's K-12 and Career Educational Corporation are two companies that can pay all of their debt with cash. Because both of their cash ratios are over 1. Over 1.5, really. K-12, however, has a 2.2% short-term debt, and Career has a 0% short-term debt. But K-12 is still dominating. K-12 has 2.2% short-term debt. They could have a little bit more, but they still have debt and they're still dominating. Career has 0% of short-term debt, and they're only a little bit higher than the rest of the companies. UTI is also a company that has all three ratios above 1, meaning that they have enough cash to cover all of their short-term debt, which is great. However, their ratios aren't as high as K-12, and they only have a 0.2% short-term debt. So they have less short-term debt than K-12, and K-12 is still doing a lot better. DeVry is doing pretty well, with only their cash ratio being below 1. So this is DeVry. Only their cash ratio is below 1. Your current right here and your quick ratio are both above 1. However, like Career Education Corp, they don't have any short-term debt as well. So they should be doing a little bit better. ITT is in last place with only their current ratio above 1, which is still pretty good because they could pay their short-term debt if they had to by selling all of their current assets. ITT also has the most short-term debt, which is 6%. So K-12 is definitely dominating liquidity. Then we have leverage. The leverage is debt. So in this one, the lower the better. So we have K-12, then DeVry, then Career, UTI, and then ITT is almost double. Well, it is more than double UTI. DeVry is at a 1.34, and K-12 is at a 1.36. So actually, DeVry has the least amount of leverage, but only by 0.02. So DeVry is at a 1.34, K-12 is at a 1.36, meaning they have the very least amount of debt compared to $1 of equity. However, DeVry has 0% debt, and K-12 has only 1.8% of long-term debt. Therefore, it makes sense that the numbers are lower. So K-12 is K-12 being 0.02 more than DeVry? I say it's okay because K-12 has 1.8% long-term debt and DeVry has 0% long-term debt. So DeVry really should be winning because they don't have any long-term debt. And K-12 has some and they're not far behind. Career is next in line. For every dollar they have in equity, they have $1.81 in debt. Career is like DeVry due to the fact that they have 0% debt as well. Therefore, Career should be doing better than K-12. UTI is with a 1.92, and ITT is with a 4.07. ITT only has 6% of debt, and that's all short-term debt, so they don't have any long-term debt. The ratio being above 4 with 0% long-term debt is very unappealing and should raise a red flag. However, I am impressed with UTI because their ratio is only 0.11 more than Career, and they are the company that has the most debt in this group. UTI has 9.3% long-term debt, and their ratio is below 2. So, UTI has the most debt, so it kind of makes sense that they're a little higher than Career, which has 0% long-term debt. Each company's financial leverage has been up and down for the past 5 years, so it's really iffy about what it is. Next, we have asset efficiency ratio, and again, this is your asset turnover rate. ITT is leading this ratio with a 1.59 right here. So this is how the means for every dollar the company spends on assets, they're generating $1.59 in sales. So every time they spend $1 on their assets, they're going to get $1.59 back in sales. So that's really good. UTI is second with $1.39. And the thing I found ironic about these two companies and their ratio is that they're the two companies with the highest leverage and asset turnover ratio. So they have the most debt, but they're most efficient with their assets. K-12 is not too far behind with a 1.24, followed by Career with 1.10 and DeVry with a 1.06. I really like how every company is higher than one. We're going to have profitability ratios. And as you can see, we actually have bars going down this time. That means they're having negative profitability. I'm using the profit margin and operating margin again. Operating margins tell us how much is left after variable costs of production, such as labor and raw materials. This ratio is influenced by management. ITT is winning with a ratio of 15.82%, followed by DeVry at 12.51%. K-12 is a 5.39%. UTI is a 1.56%, and Career is a negative 18.16%. This means Career is out of money before they finish paying production costs. The profit margin tells us the percentage of sales that go towards net income, and ITT is winning this one as well with a 5.55%, followed by DeVry 5.44%, K-12 3.31%, UTI 1%, and Career negative 15.54%. The companies actually are aligned with how well they're doing. These companies, if they're doing well in operating margin, they're doing well in profit margin. So ITT was first in both sections, DeVry is second in both sections, K-12 is third, UTI is fourth, Career is fifth. And that is pretty interesting because in the soft drink manufacturing industry, that wasn't happening that way. Valuation ratio. Bloomberg, unfortunately, did not have a ratio for Career. And I think that is because of the negative profits. But because there's negative profits, we don't even really want to invest in this company anyway, because we want a profitable company. So I wasn't too worried about it. UTI UTI is dominating this with a 64.37%. $64.37 is how much the customer is willing to pay for every dollar they earn. So the marketplace thinks UTI is the best. K-12 is in second place with 36.49. DeVry is next with 11.48, followed by ITT at 7.54. Now, what else I think about when I look at this is it too expensive or is it not expensive enough? I feel like UTI being $64.37 per dollar of earnings, I feel that's a little overpriced. So I would actually be kind of iffy about that. Taking all the ratios into consideration, I came up with a conclusion, and my conclusion is K-12 wins. Yay! So again, you can see the quick ratio, leverage ratio, asset turnover, profit margin, and PE ratio throughout the past 5 years, up until 7/8/2014. That's when the current is. After evaluating the numbers, I would say that K-12 Incorporated definitely trumped other companies. K-12 is the most liquid company with the second least amount of obligations. They are also in second place with their valuation ratio. The market clearly values them, but they aren't overvalued yet. They are also in the top 3 for the most profitable company who uses their assets efficiently. With this evidence, I believe K-12 is in a good place to keep profiting and improving. K-12 also has the weighted average cost of capital with a 7.2%. So K-12 definitely has some potential, and your profit margin, you see, is starting to go up right here. Your PE ratio, at one point in 2011, it was over 70, and I feel that it can go over 70 again. So I feel like now would actually be a good time to even invest in it. My next industry is casinos. I have Boyd Gaming Corporation, Isle Capri Casinos, MGM Resorts International, Penn National Gaming Incorporated, and Pinnacle Entertainment Incorporated. Of course, again, first ratio is liquidity. So I have Boyd, Isle, MGM, Penn, and Pinnacle. Current, quick, and cash. Pinnacle Entertainment has the best current ratio. Therefore, if they all of a sudden had to shut down shop, they can convert all current assets to cash and could more than cover all of its debt. However, the current ratio isn't everything. As expected, MGM has no short-term debt and has the best combined ratios. The current and quick ratio are both over 1, and the cash ratio is a 0.81, which isn't that far from 1. Therefore, we know that MGM will survive without the sale of inventory. But they would have to do something if they had only cash. They would have to sell something in order to pay off all their short-term debt. Penn is the next best company according to the combined ratios. Penn has a current ratio that is 0.18 more than MGM, but their quick and cash ratios are both below 1. So even though MGM has a better, Penn has a better current ratio, their quick and cash ratio are under 1, and MGM's quick ratio is over 1. So combined ratios, I feel that MGM is definitely doing better than Penn. If we were just looking at current ratio, of course, Pinnacle would actually win. Next will be Isle and then Boyd. We have leverage ratios, and that's your debt to equity. A lot of you know it better as that. Penn National has the lowest ratio of 2.6, meaning they have the least amount of debt compared to $1 equity. So for every $1 of equity, they have $2.60 in debt. They also have the second least amount of long-term debt, making up 51% of their capital structure. MGM is next in line with a 6.09. They're also the company that has the least amount of long-term debt, with it making up 50.5% of their capital structure. Next is Isle, 9.6, Pinnacle, 11, and Boyd at a 15.6. So therefore, Boyd has the most debt. For every dollar of equity, they have $15.60 in debt. And that's not very good. Okay, so now we're going to look at asset efficiency and how well are they doing with their assets? How well are they doing selling their assets? Penn National is leading this ratio with a 0.75. This means for every dollar the company spends on assets, they're generating 75 cents in sales. Isle is in second place with 0.59, followed by Boyd, 0.48, Pinnacle, 0.41, over here, sorry, and MGM, 0.37. So, Penn is definitely doing best with their assets, but none of these ratios are over 1. So, I don't like that. Next, we have the profitability ratio. And every one of these companies' profit margin is negative. And that's not good. Their operating margin is positive, so that's good. And remember, operating margin is influenced by the management. So they have good management. This ratio is influenced by management, and Penn National is winning with a 12.35%, followed by MGM at a 10.89%, Boyd 10.17%, Isle 10.02%, and Pinnacle 8.18%. That's just operating margin. Now profit margin, they're all negative, so MGM is going to have your best profit margin with a negative 1.6%. It's not too far from zero, but it's still negative. Then Boyd, we got a negative 2.77. Isle is a negative 5.15. Pinnacle is a negative 17.12. And coming in last place is the company who has the best operating margin, and which is Penn, who has a profit margin of negative 27.22. So if you remember, for the college and university industry, they actually had, if they were doing well in the operating margin, they were the best in the profit margin. Well, this is actually opposite for Penn National. Penn National has the best operating margin, but they have the worst profit margin. So it needs to be fixed there. That is not good. Penn National definitely has potential. They got to figure out what's going on, what's wrong. And next is valuation ratio. Now, Bloomberg did not have a lot of the valuation ratios. So, for what I did have was Isle and Pinnacle. And Isle is dominated with a 64.68. And Pinnacle is in second place with 16.79. So that's how the market values. Now, my conclusion after going through all of the data is that MGM wins. With this industry, I had a hard decision to make. All of them had a negative profitability ratio, and that alone makes me uneasy. And Bloomberg was missing a lot of the PE ratios. However, numbers are numbers, and after evaluation, I narrowed it down to two different companies, MGM and Penn National. These two companies compete against each other for the best ratios in almost every category. However, MGM is having the best PM profit margin, and Penn National having the worst. It was clear to me that MGM is the best company. They are the most liquid and the most profitable company, and they are second for the lowest leverage ratio. One recommendation for MGM is to watch their asset efficiency, due to the fact that there is definitely room for improvement in that area. So, like I said, I didn't really like picking out of this industry, and I wouldn't really invest in this industry because if you see this profit margin, it's so down, up, and that's how every company, all 5 companies that I evaluated at least, is like that. So it's just so unpredictable. Well, out of the 3 companies that I chose, which would be Monster, K-12, and MGM, I'm going to tell you which one I think is the best. So if you look right here, again, this is all 2013 figures. And whenever we did the lines, like with our top companies out of each industry, that was a trailing 5-year average, the trailing 5-year trend. But now we're doing 2013 because we're going to compare each. We got Monster in the pink, K-12 is purple, and MGM is orange. MGM didn't have a PE ratio on Bloomberg, so that's why there's none there. As you can tell, K-12, which is purple, has the best quick ratio, also the best leverage ratio, and the best PE ratio, which is right here. Monster has the best profit margin. Well, Monster's killing it with the profit margin. And asset turnover, right here. It's not too much ahead, but they're definitely ahead. Because of the fact that Monster isn't very far from K-12 in the other categories, so when the categories that K-12 won were quick ratio, which there's Monster not far away. This is leverage, which K-12 and Monster's not far away. And PE ratio, K-12 and Monster's not far away. And because they know how to make profit way better than K-12, and they're not too far behind on the other ratios, Monster would be the company that I invest in. Monster knows how to do profits. Monster knows how to flip over their assets. And quick and leverage ratio, PE ratio, they're not far behind. Monster is definitely the company I would choose out of the 3. And that was my presentation and my research.